On today's show, 3 questions. Number 1, how much longer can Americans keep spending like this? Number 2, is the Magnificent 7 bubble going to pop? Number 3, how wrong was Matt, yours truly, about the sports gambling problem in America? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
Yo, guys. Good to have you. I apologize. I'm a little under the weather. I'm going to try to limit the sniffles as much as I possibly can. Really quick, though, as far as I have a cold right now. Have
Just
you guys
makes your
heard?
voice more sultry, Matt.
Yeah,
So
I
it's
don't know
good.
about that. I'm literally trying to not sniff as much as I can. I got a little bit of a runny nose. But have you guys heard this whole thing, the whole man cold thing? Taylor, do you subscribe to this thinking?
Oh, I am. Describes me to a T.
Oh,
know,
you have
I
the man
shut
cold?
down. I shut down the second I get a sniffle.
Rabih, do you know what this is?
No idea.
So there's this whole concept called the man cold. I think it's probably been more propagated by women, just to show how weak men are, and they're not wrong. They're not totally wrong. But I'm so anti this in regards to my own life that I actually try to swing the other way, where I'm like, I'm not sick, and I'm like, I'm never gonna have a man cold. I go to the gym still. Like I was at the gym this morning, sick as a dog. Sorry, that's probably inappropriate now post COVID, but I was. Anyway, so the man cold is kind of like this concept that when a man gets a cold, he, like Taylor just said, he like shut down for a week. Basically, you like lay in bed. Like men respond to
I don't
sickness
go a week. That's
a couple days, maybe.
Yeah, I
If
try and
I
just do
can
a
find
day.
one extra reason to shut down, I'm taking it.
Maybe that's what it is. Maybe that's what it is. So Taylor, you're openly for the man cold. You lean into it.
No, I will say my wife loves to talk it up, and she makes it sound worse than it is. So when
Yeah.
I'm around her, I push through. I get my work done. I do everything I can with the kids. But at night, I'm like, I'm not doing anything extra, Shubs. I'm going to bed at
I'm sick.
7 p.m.
I
am
have a
sick,
cold.
and I need to get some rest.
Oh, I love that. Okay, well, I have a man cold right now. We will still fight through. Let's start with Rabih. How much longer can Americans keep spending like this?
Yes, this is interesting how I ended up talking about spending and consumers, but for the last week and a half, we didn't really get a lot of new economic data. So I usually take the opportunity to go back, review what has happened in the market, and try to formulate the narrative in my mind. And we've been talking about soft landing versus recession for a long time now, right? And the 2023, the GDP ended with 3.1% real growth, which we've covered multiple times. But I wanted to see what really drove that and how long can it last. And we know, as we've said multiple times on this podcast, that we spent our way out of a recession in 2023. The US consumer contributed around 85, 87% of that 3.1% real growth. And we're like, okay, can we expect the US consumer to also spend us out of any troubles that we might face in 2024? And this will really depend on whether the consumer has the money to spend, because if the Americans have the money, they're gonna spend it. So I started looking at indicators of consumer spending and the health around it. And the major ones are whether you're employed or not, because this will give you a salary to spend. And two,
That makes sense. That makes sense.
it makes sense. And the other one is whether you're depleting your savings and you're bringing on more debt onto your life through credit cards, student loans, car loans, etc. And I got you the data, guys. So let's look at it. So in terms of unemployment and employment, the economy is still very strong. Although throughout this earnings season, there has been a lot of companies showing that they are laying off their employees, but employment is a lagging indicator. So in the next couple of weeks, we might see unemployment tick up, which would tell you that discretionary income is dwindling a little bit in the economy as a whole. But this is not the major issue. The major issue, I would say, is lifestyle. In 2023, consumers spent so much that all their accumulated savings from their fiscal stimuluses during COVID, from really strong economic growth in 2021, 2022, 2023, in a sense, are drying up. And this is showing by increasing debt levels. We've talked about how credit card loans just reached $1 trillion in 2023, but adding on more debt is one thing, and adding on debt that has become bad debt is something else. And the way we see whether it has become bad debt or not is actually by looking whether it's considered in delinquency or not. Delinquency is a borrower hasn't made a payment in over 90 days. So that would put the credit card or the auto loan in question, under the radar of banks. So just to give you some numbers, the flow into serious delinquencies, which are 90 days or more, back in Q4 2022 was around 4% for credit cards and around 2% for auto loans. By Q4 2023, so a year later, credit cards moved, like the flow out of all new credit cards that are being put up, what percentage of them are becoming delinquent? Usually 2022 was 4%, 2023 jumped up to 6.4%. And auto loans went from 2.2% to like 2.6%, which is a significant amount, because if you think of it from an annualized perspective, approximately 8.5% of all credit card balances in the US are in delinquency, and 7.7% of all auto loan transitioned into delinquency this last year, which tells you that, and this is a report by the Federal Reserve issued February 6th, so it's pretty new, and this just tells you that people are running out of their savings, and this is more of an impediment on them servicing all the debt that they have. And this is a sign that the consumer might not last as much as we think to get us out of trouble.
Rabih, did you, sorry, with those numbers, do we have historical data of what's, like you're comparing 2022 to 2023 and the jump, and that's obviously a big jump, but do you have any data or, and if I'm putting you on the spot here, but like what is historical ranges of that?
I don't have the actual historical range, but those numbers, according to the article by the Federal Reserve, are above pre-pandemic levels. If we are thinking in averages, it means we are above average in terms of delinquencies so far.
Got it.
As the financial situation gets worse, we move from delinquencies to actual default. And usually when a recession happens and one like that really makes the news, and when people start defaulting. But we are still at that early stage, but this is more of a momentum that we're heading towards that direction.
Yeah, I mean, to your point, you're racking up bad debt, right? Which we would consider for sure credit cards bad debt. It's one thing to rack that up, but still maintain a job and be able to pay that off or not go fully delinquent or obviously default. I think what you're talking about is this perfect storm that could be created if we have weakness in the job market. All of a sudden you see those people start to lose their jobs and then they truly can't pay that debt off. Then it becomes a real problem. Kind of compounds on itself is what you're saying, right?
It is, simply because the banking industry is so leveraged. Like, just give you an example. Last week we were talking about New York Commercial Bank, and that thinks the market value slashed by 48%.
Yeah.
It was simply because there was an increase of like 1% of their $100 billion loan assets. 1% of those were allocated to loan provisions. Just a 1% tick in, assets that are prone to default shattered the stock price for 5%. So imagine if it's at the scale of the US consumer. But this is just a snapshot in time. We would expect, monetary policy to intervene and try to lower the financial burden by like cutting interest rates if those signs exacerbate. But it's going to be a matter of timing, whether it happens before, financial markets freak out, or it's going to happen after.
Add on top of that, which we're not going to go dive into today, but we've talked about in the past with the student loan balances, somewhere in the range of 1.7 trillion now, on top of the credit card balances that you're talking about. Those student loans, as we all know, have kicked back on, but something like with payments, I read, and we actually hit this recently on 2 cents, only like 60% of people actually made their payments. So I wonder if there's also a sign there of people not being able to make these payments, obviously the servicers and all that. But basically, it sounds like what you're saying, Rabih, is there's some caution we need to be approaching this with how big the total balance of credit card, student loans, auto loans, It's kind of becoming something we need to be more aware of.
It might nothing might happen, and this is not really the point. We're not trying to predict whether this is gonna be
Oh,
what
yes,
hurts
we
the
are,
economy.
Rabih. Oh, yes.
Yes, we are. But going back to the main question, can we like place our bet that the U.S. consumer can also salvage us for another year? It doesn't look like it. So you would want to look at other parts of the economy. Consumers are around 60-70%. You still got the industries, investments in terms of companies. Those can contribute, the government can contribute, exports and imports can contribute. This is just one slice of looking at the big picture, and while it's still very, very strong compared to the rest of the world, it is showing some signs of weaknesses, which means other factors have to come into play for us to stay in the good position we're in.
And to your point, I'd imagine Jay Powell and his team at the Fed are very aware of this when it comes to their approach to lowering rates and the timing of all that, I'd imagine.
Yeah.
Got it.
That's what
that
they've been
reminds me of what
communicating.
you guys talked about last week with Jake, right? And Jake, I think, asked this question on the podcast, like, I don't know why he's lowering interest rates. And to me, it they're aware of everything Rabih's saying right here, because I also think, to your point, Matt, with the student loans, not only have they kicked back in, but they're kind of a delayed kick back in, because we're going off of income from 2019's tax returns. So I know from personal experience, most of my dental clients, they're not truly making a real payment on their student loans yet, because they haven't had to recertify their income. So not only is there all this data Rabih's mentioned, but even with the student loan payments themselves, they're about to go up considerably over the next 6 to 12 months as everyone has to recertify their income to current levels from 4 years ago.
So true.
Really good point.
Yeah, it's a really, really good point, Taylor. Okay, Rabih, thank you for that. Anything else you'd add to that?
All good.
Okay, Taylor, let's jump to yours. Tell us, is the Magnificent 7 bubble going to pop? First of all, fantastic question. You just threw that out there. I was like, this is going to get the people their ears perking up. I love that. But give us some context of why you're thinking about this.
Well, the context is I am a relatively young advisor, and I have experienced
It's a subtle flex there. It's like, I'm so young.
Well, and it's not meant to be a flex. It's meant to be the opposite of a flex.
I was going to say, in our industry, it's actually not a flex because people don't like that.
Yeah, because, I mean, let's face it, I have really not faced a true recession yet on the front lines dealing with clients. 2020 was a dip, but it wasn't a recession. I mean, it was historically the quickest recovery we've ever had.
Yep.
So I have never had to go through dealing with clients through a multi-year recession with, multiple years between all-time highs, right?
Yep.
So when you see something like the Mag 7, just inflating the S&P 500 and relative to, I think you mentioned this the other day, Matt, the Mag 7 is the size and bigger than some countries in the world now, right?
Yep.
The size of these 7 companies is as big as countries that exist in the world right now. So, you look at it, and because it's so big, you naturally could think, man, this is a bubble that's going to pop, right? Because these top 7, for example, in the article that I was reading and brought up for this topic, they mentioned that 4 of these top 7 account for roughly 69% of the S&P 500's gains this year. So 4 companies out of 500 are accounting for 70% of the gains this year.
Wow.
Right? So you can naturally look at that and think, that looks like a bubble. So what this article went into and was looking at is, well, has this ever happened before? Right? Because that was my fear as an inexperienced advisor. I felt, man, this feels like this has never happened. Right? This feels different.
Well, there's so much talk about it, right? There's so many headlines about it, so much talk about it. So it's natural for us to be like, oh, dang, like this kind of, those numbers are kind of crazy.
Yeah. So an economist went back and they said, okay, since 1992, so 30-year time horizon, what has happened or what has been the case when the top 10 stocks in the S&P 500 accounted for basically the majority of the growth from the S&P from that year, right? Basically what happened in the S&P 500 the subsequent year after the top 10 companies in the S&P 500 were the cause for the majority of the returns. And this has happened 7 times in the last 30 years, right? Which immediately put me at ease, because it was like, oh, okay, this isn't different.
This is relatively normal. Yep.
This happens. And that's what they said in this article. This is a feature, not a bug. This happens in the market. But what a lot of times we forget, so basically out of these 7 times that this has happened, 6 out of the 7 had a positive return the following year. And the average return the following year of the S&P 500 was a 14.3%.
Oh, you're back.
Am I back?
Start again at the average return.
Okay.
I can edit.
So good. 6 out of 7 of these times that this happened, it was a positive return, and the average return of all of them was a 14.3% return the following year.
Okay.
Right.
We like that.
So we look at this and you think, oh, well, obviously this can't go up. Well, in all of these examples where it went up, it wasn't because the Magnificent 7 or the top 10 stocks continued to outperform. What happened is the floor raised. Yep. All of the other companies caught up, right?
Yep.
And that's the thing that we forget with a bubble sometimes, is it doesn't necessarily mean just because these particular stocks have grown that they have to come back down, right? Other times it just means that the other stocks that are lagging below need to catch up.
Yeah. Regression to the mean works both ways. So it's like if those 7 drop, but the other 493 raise, to your point. That actually intuitively makes a lot of sense. Rabih's got thoughts for sure. He is so excited right now.
I love it.
He's giddy.
The example he gave is so good, and it highlights 2 points. Not every expansion is a bubble. The bubble needs to actually be disconnected from fundamentals. So when we think of like the .com, the reason those tech companies went up so high wasn't because they were leading the forefront in terms of new technology and changing our lives. It was because of shadow companies and just, kind of a pyramid scheme where the hope of investing in this company is not because it provides values and dividends, but because I can sell it to someone else at a higher price. So that's one feature of what the bubble that might pop is, because it's just not based on fundamentals, whereas right now corporate earnings in the tech sector are based on fundamentals. And the other really good point that Taylor mentioned about the floor raising up is because we kind of mistaken and aggregate the whole economy into one cycle. But in reality, the economy is made of multiple business cycles that depend on the industry they are in. And some industries are more sensitive vis-a-vis the other industries, and others are more, stable vis-a-vis the other industries in the economy. And those that are more sensitive usually tend to be leading in terms of economic growth. So what's happening in this situation is that we've got the tech industry, given our current lifestyles, is the leading industry in terms of economic growth. And the spillover effect of the new technologies that are being brought up are harnessed by the other industries, and they are catching up. Back in the 70s and in the 80s, the leading industry in the US was oil and energy. And those were the top 10 companies in the S&P 500. And whenever it wasn't a bubble in a sense that it would pop, they would lead the growth and let the other industries catch up. Which brings me to the third point that I find very interesting. Investing in those companies is great, but now from this moment forward, the higher expected return is found by being diversified and in those companies that are going to catch up, instead of staying at those that already reached the finish line, between quotations.
So anyone out there who's thinking or has thought over the last few years, oh, why don't I just put all my money in NVIDIA or Facebook or Microsoft or Tesla or Amazon? You're highlighting exactly why you wouldn't want to do that. And it's the same thing we talk about over and over and over again. Diversification and time are the 2 secrets to investing. So,
and chances are you're probably more exposed to those than you realize.
Oh, definitely.
Right. I think a lot of people don't realize how much exposure they have in their portfolios to those companies already.
Yep, absolutely. Yeah, you own any of these major indices, you're going to have, especially the S&P, you're going to have massive exposure to these companies. So, Awesome. Taylor, anything else on this, or Rabih, any other thoughts on the Magnificent Seven bubble popping? I loved your point, Rabih, of saying it's so much more nuanced than just saying, just because like a bubble doesn't mean we've seen so much growth, so it has to pop. A bubble is when you have disjointment of the price versus the fundamentals. It made me think of what's happening in real estate and people saying, oh, this is just like 0809 because it's so simple to say prices have gone nuts. It's just got to be like 0809. And it's like, no, it's actually so fundamentally different, even though the one variable you're looking at is prices going up dramatically.
And the residential more real estate, yes. Commercial is a different story. But
Well,
residential,
commercials,
100%.
sorry, specifically residential. Yeah. Exactly right. So, because I've heard this so many times, even in our area in Salt Lake, that's grown so much. I think it's one of the top. I think I saw recently. It's like one of the top 5 cities as far as from the last. It was like the last 3 or 4 years, the amount of growth we've had in prices in residential, specifically residential. So people see that and they immediately think, and because all the headlines are like, we've talked about this, right? Headlines say, oh, we haven't seen this type of growth in this X, Y, or Z thing since 0809. So immediately we think, oh, it's got to be just like 0809. No, it's actually completely different. And just because prices have dramatically increased in the residential market doesn't mean it's a bubble about to pop. And you're kind of saying the same thing about the Magnificent Seven. So awesome. Again, anything else, guys, on this before we talk about how wrong I was last week?
No, I can't wait.
Okay, perfect. So Rabih, to be fair to this, Rabih was actually really, really hesitant to do this. I was like, let's do this. I want to call myself out. And so Rabih and I got into a little spat last week. We hugged it out after. We didn't really get into a spat, but I did say it was our first fight as a couple on this show. As the 2 main people on the show, we finally had a little bit of a disagreement, of which I immediately was like, well, if Rabih disagrees with me, I'm clearly wrong. And we have just proven that out. So the question was, how wrong was yours truly about the sports gambling problem in America? Just to recap, what I said last week was, as we were talking about sports betting, prop bets for the Super Bowl coming up, my first response was, I think it's kind of fun. Like, I think people should actually be embracing this. The caveat there, though, and I did say this, and I still stick to this, that this goes, I guess, maybe without saying, that you would have some rules around it. You would have some discipline. You wouldn't actually have like a gambling problem. But then Rabih, later on in the week, posted in our internal DA Slack a video talking about the gambling problem in America and what an issue it's become. And then I since went on to find some pretty jarring stats that maybe I shouldn't have been so cavalier about just go have some fun with it. So Rabih, do you want to start here of maybe recapping the video you sent? We don't need to go into great detail, but I guess maybe talking first about the sheer size of the gambling market. That kind of blew my mind. And then I'll throw some stats here about maybe this isn't the fun thing that I kind of, again, flippantly said last week.
Yeah, definitely. And just to give you some background, guys, it was like Monday night at like 11:30 p.m. and I find that video and I send it to Matt immediately. And I think I watched it once on normal speed and another time on like 1.5 speed just to make sure I've got the arguments right.
Yes. And my immediate response was, well, see, I was wrong. There you go. Fully admit it.
But there was an interview online. It's a well-detailed report about the gambling industry in the US, especially sports betting. And given that since 2018, the government, in a sense, the Department of Treasury, SEC, allowed for such companies to emerge, and they have taken the market by a storm in the last 5 years. The size of the US stock betting industry is now larger than the GDP of Greece, which is a country in the Middle East.
Wow.
So it is such
the size of the sports betting, right?
Yeah, just that sleeve
sports
of
betting.
the industry.
That is wild.
And it is fascinating. And you don't get to that size if you don't have gambling addicts, in my opinion. I'll give you more stats from that video. Something else that they mentioned that was very important is how uneven the playing field was. So I'm a markets guy. I love the stock market because it's a
Really?
place that, yeah, obviously. I'm a markets guy. I love how democratic it is. You do not do a trade unless the buyer and the seller are both fully conscious in their full awareness, agreeing to a middle point price where a transaction can happen. However, when you are playing on an uneven terrain where those uh, sports gambling companies collect hundreds of data points about you from, the usual age, location, behavior, all the way down to like how long does it take you to click on a thing when you are confronted with like something flashy, to trying to imply how behaviorally you are susceptible to addiction, and then sending you notifications just at the right time, right just after the proper advertisement to push you to bet more and make that decision in a compromised position where you're not fully acting rationally, just tells you that this is just shifting their odds out of your favor towards their favor, which makes it a non-equal playing field, makes it feel like a losing battle to go into from the first place. Like, and from my perspective, I would not mind at all to enjoy the risk of maybe I'll be right, maybe I'll be wrong, but at least I need to make sure that it is fair and that in the long run I would not lose my money. So if it's fair, I'm all for it. I have nothing against gambling, but the current landscape is not the way it is, unfortunately.
Yeah, when I think that the issue is you really look at the numbers, and we'll throw some more out here to give the scope and the scale of this thing. But the more I thought about it, and after we talked last week, and then you sent me that video, how frictionless it is, I think, is the biggest problem, right? When we talk about like how Amazon changed the consumer market, right? And now other companies have gotten on board, and now you've got social media, and meaning Amazon built an empire off of basically creating a whole new way to purchase, right? They were the ones who patented the one-click buy. Like their whole basically company was based on removing friction from the buying process. You see this with studies around credit cards and everything, right? It's the same here now when you talk about sports betting. And so before I made my dumb comment last week of like, this is fun, just like go do it. To your point, Rabih, the size and scope of this thing. So since 2018, 38 states have now, plus DC, have now legalized sports betting. It has exploded to a $7.5 billion industry. It is on track, based on current trajectories, around to be $182 billion by 2030. And again, all of this coming on the backs of the accessibility to it now. What was the most jarring thing for me? And this is where I was like, holy cow, we got to redo this. And I got to, like, again, call myself out and give some more seriousness to this topic. So the National Council on Problem Gambling, the risk for gambling addiction increased by 30% from 2018 to 2021. Men's Health did a survey. And by the way, this is specifically usually men around 18 to 24 as are the most prone to this. But Men's Health did a survey. 1 in 5. So over the past 12 months of those who actually placed a sports bet, 1 in 5 allotted a quarter of their paycheck to sports betting. A quarter of their paycheck. That is unbelievable. 58% say that sports betting has affected their mental health, and 43% know someone who has or may have a sports betting addiction. So again, calling myself out and then making this like, this is no joke. Like, this is not like, go have fun with this. I still contend if you're going to do this, obviously have rules, and assuming that you have rules and you're disciplined and you're not betting something that if you lost it, like I use Jake as the example. I still think there's a healthy way to do this and have fun with it. But I also would be not giving the whole story if we did not give these numbers and talk about what a serious problem this has become, and probably will continue to be even a bigger problem if something's not done about it.
Yeah, imagine what would happen if all these people put a quarter of their paycheck into just a high yield savings account. How much more successful they would have been.
Yeah. I mean, I think all the time what I would have done if, as opposed to buying Monster energy drinks over the last 10 years, if I just would have put that money into Monster Energy stock, I'd probably be, or Domino's Pizza, as opposed to eat it, just invest in it. But yeah, I mean, Taylor, that's such a good point. The numbers would be off the charts on that one. Rabih, looks like you've got other thoughts on this.
Yeah, the main point, it's gambling on a game with a friend because it's fun is not the issue. The issue is whom you're gambling against. And it is a house that, it is, in the interview, something they brought up that was very funny. There are bets about like how many times someone will drop the ball or something. It's not even related to the game, or how many times
these prop bets.
Yeah, the prop bets, the referee will whistle and then say, oh, never mind. But the thing is, it was on a game in a sport that Americans do not watch, between two players who are not even in the top of their league, which means there are no viewers there, but there's still volume on it. People are still betting. So this really shifted from a fun experience with your friends because you love the teams that you are watching. It is meaningful to you, to just simply find any bet out there, which just makes those companies a money-making machine that does not really care about anything else but making you spend more. And given that regulations are still very new on this, allows them to get a lot with a lot.
Yeah.
So this is the problem. Gambling has existed for a very long time. It wasn't really, between quotations, an epidemic like it is now. The reason it is now just because the other side of the table is not is abusing some loopholes.
Totally. And again, anything else you'd add to this? Awesome. Okay. Taylor, we may have lost you. He might be a little frozen here. So if he has something else, you'll have to save it.
He'll come on next week.
Save it for next time, Taylor. Okay, guys. Taylor, Rabih, thank you so much. As always, we are going to plug the Dentist Money Summit coming up June 20th and through the 22nd in Park City, Utah. We have limited seating. Seats are filling up. That is not like some thing I'm just using as like a tactic. We do have limited attendance, obviously, with the size of the venue. So check it out, dentistmoneysummit.com. It is going to be an amazing event. We have an interview with James Lawrence coming out here pretty soon. Hopefully we'll get you even more excited about it. We're going to be talking to Daniel Crosby here at the end of February as well, who's also a speaker at this event. So check it out, dentistmoneysummit.com. That is it. That is our 2 cents. There's only one thing left to do. Taylor and Rabih, you know what that is. Go forth, live your rich life. Till next time. Bye-bye. Maybe.
It's still